Spotlight, River Oaks Capital, a look into Wit Hugly. Hello everyone. As always, I'm grateful to all of you who subscribe to me, and I appreciate your support. Just like you supporting me, I also have multiple newsletters anchored on my inbox. One of these is Bogumil Baranowsku's Substack. He himself also runs an investment fund and is an author. His Substack is documenting his interviews and insight. I really enjoy his content and his frequent podcast guests, not to mention he's also an author of 3 published books, so feel free to check him out. You won't regret it. The reason I'm bringing all of this up is that the last guest to visit Bogumil Baranowsku's podcast was Whit Hugly, in which he went into detail about himself and his fund. If it's not super obvious, I really enjoyed their talk and went down the rabbit hole of learning everything I could about Whit Hugly. Potentially coming across as a stalker, I searched through all his public information I could gather from his podcast appearances, guest panel speeches, and writings, as well as over 770 tweets from which I found old writings, and also the fact that he's a big New Orleans Saints fan. Today I wish to share these lessons I've taken from his investment journey, and I hope it brings you some entertainment and value. History. Whit Hugly graduated from Louisiana State University, LSU, with a Bachelor of Science in Political Science and a minor in Business in 2011. Afterward, he worked at New Orleans food delivery startup called Igor Nutritional Delivery. His work experience inspired him to return to school to develop and hone his business skills, enabling him to pursue his own venture startup upon graduation. He attended Tulane University to pursue his MBA. While studying, he had the pleasure of taking an investment analysis class that introduced him to Ben Graham's famous The Intelligent Investor. This encounter proved pivotal to his career trajectory and the intention of becoming an investor. He also started his CFA journey studies. He interned at AGR Partners, a private equity firm, and worked at Berkner Road, a student-run equity research program at Tulane University. After obtaining his MBA, he relocated to Visaine, California, where he rejoined AGR Partners full-time. At AGR Partners, Whit joined a lean deal-making team that provided him with exposure to well-rounded skills necessary for his boots-on-the-ground style of investing. A notable anecdote from this time was his experience with the Pistol at Dawn bidding process, when two 50% owners bid on paper, and whoever has the higher bid buys the loser from the sum they had on their paper. While working at AGR, Whit began managing his family and friends' accounts in small public companies with an owner's mindset. First on weekends, then on January 1st, 2020, at his own fund. Here he discovered that the public markets are even more inefficient in small companies than private markets. Today, he runs River Oaks Capital full-time in pursuit of taking advantage of this discrepancy. His goal is to focus on microcap companies, and he's currently accepting investors. Current funds under management are under 100 million, and from what I know, he doesn't want to go over that 100 million hurdle to keep his opportunities open and not hurt his future and present investors. Fund philosophy. Whit's approach to investing stems from the same fateful encounter with Ben Graham's The Intelligent Investor. He thinks of investing as buying ownership of a business and treats each purchase as if they were buying the whole thing. The notion of margin of safety and understanding what he owns and the pillars are the pillars of his approach. His fund focuses on owning 8 to 15 businesses that he thoroughly understands with a market capitalization of $30 to $600 million. His stocks can be categorized into 2 categories, an excessive discount and a wonderful business. One is a notion borrowed from Ben Graham's net investing, where you're buying a dollar for less than 50 cents on the dollar, and you really have a situation where heads you win big, tails you don't lose much. The other is a high-quality compounder that you can watch run until it takes a left turn, one which the business changes trajectory either by entering a new industry or making non-shareholder-friendly decisions. His checklist. Whit follows a checklist as a framework to keep track of what is worthy of remaining or joining his portfolio. He has started that one of his mistakes was not following his checklist and has emphasized its values. The checklist includes companies that sells a wonderful product that will generate substantial cash for years to come, treats their customers, employees, and community admirably. It is run by honest and able people who also have ownership in the business. Poor note, he has made a mistake of overweighing a board's alignment with the CEO when the CEO didn't have enough sway over the voting shares. So misaligned incentives there. Does not take excessive risks. Again, leverage variable interest rates. Has a long-term plan for the business. Is selling ownership at a significant discount to fair value, margin of safety. His advantage. To understand what drove Whit into the microcap space is the realization that Much of what he was doing in the private equity side, including the due diligence and research, is highly effective for small companies that are not well covered. He has anecdotes about when he first started researching and visiting companies, often being the first investor to visit them in over 5 years, which demonstrates that he's really turning over rocks that others aren't looking at. In shareholder meetings, he could easily be one of 3 people there providing direct access to management that larger funds simply can't replicate in their target markets. He realized his advantage lies in his small fund size and his very long-term view. His motto is investing with an owner, long-term mindset in a selected number of underfollowed public companies, and a thorough approach applying due diligence research to companies that receive little to no analyst coverage. For those wondering how he finds companies, he has repeatedly stated that he does not use screens, as they often don't work. There's always one thing or another that makes them unscreenable in gap counting. His preferred method is bouncing ideas off his network, attending conferences, and occasionally going through the A to Z through stock listings. His lessons. Since the fund's inception 5 years ago, Whit has navigated through market downturns and exuberance. He has condensed his lessons into 4 or 5 pillars that help him determine elements that make a business successful for investments. His big pillar, and in his eyes the most important, is when he calls a business run by an A-plus manager, someone who could easily be running a Fortune 500 company, but for one reason or another has decided to run his current position. Whit also references another definition of an A-plus manager. He draws on Jim Collins' book, Good to Great, where Jim describes a level 5 leadership style that combines personal humility with professional's will, prioritizing the company's success over personal gain. Another way to look at it is that the person running the business is both shareholder friendly and understands his business inside and out, and is a great capital allocator. This emphasis on management echoes Phil Fisher's timeless advice. Fisher once reflected, "I have stressed management, but even so, I haven't stressed it enough. It is the most important ingredient." Again, in my books I've always placed an emphasis on the importance of management team in selecting companies, and yet I don't do it enough. It is the most important ingredient. Whit emphasizes the smaller the company, the more the fate of the business is intertwined with the person at the helm. As such, he allocates a lot of time getting to know management by flying to meet them, arranging meeting, and meeting other shareholders. His other big insight is how prices can move in microcap space. For example, he understands that irrational pricing can take years, if ever, to correct, meaning a company can trade at 50 cents on the dollar for decades. Take another example. Big drawdown in stock price due to forced selling by a large shareholder is This is not common or possible in large caps. Rather than viewing this as a disadvantage, he uses it as his advantage, reacquiring his own business at a lower valuation. He employed a successful investment strategy that aims to educate management to guide them towards informed capital allocation, precisely taking advantage of the undervalued nature of the prices to buy back shares, or if all fails, dividend. His other lessons has been that smaller the companies, debt and leverage are more dangerous than in larger companies. Many loans can be structured as variable rate loans, and significant fluctuations in interest rates can be a detriment to the business. This is why, regardless of the debt level, he buys a business at a substantial margin of safety. Great margin of safety can ensure that even with lackluster decisions, decent return can still be made. For example, he bought a company and even averaged down with the price as management made bad decision after bad decision. When the company was sold to a competitor, he was able to exit at a break even thanks to his margin of safety. The last pillar, insight, stems from the traditional understanding of a moat does not exist in the traditional sense in small caps. What he means is that if we're honest, any big company can easily compete with a small company simply by burning cash if the opportunity is attractive enough. Therefore, the notion of a classic moat is non-existent for these businesses. What he wishes for is companies that think of themselves as a stranded island in their own small niches, so good that when the competition does want to enter the market, they just buy them out, preferably at a big premium. And it's a cheaper option than burning cash to compete. This could be due to a law of large numbers, as doubling revenue for a $100 million business versus a $1 trillion business differs significantly in companies at various scales. Performance. As you can imagine, starting the fund on January 1st, 2020 is quite the time to start a fund. Whit has shown that he won't stray away from his principle and has invested through the turbulent times. Although 5 years is a relatively short time to track someone's career performance, it remains an important data point. Over the past 5 years, River Oaks has delivered a return of 11%, annualized return of 11%, approximately 10% after fees, compared to 14.4% for the S&P 500. It's important to note that this fund has so far underperformed the index. However, I don't think this will be the case over Witt's entire career. Even Walter Schultz used to say, I think the first 10 years you get kind of acquainted with what you're doing. Truthfully, the statement is also a motivational point for me. So I'm looking forward to future years. Takeaways. There's really a lot you could take away from River Oaks Capital. I think that throughout the interviews and reading Witt's letters, there were more than one instance where I had to pause, go for a walk, and digest his thinking and ideas, and in the process enhance my own understanding of business or investing. The growth and the quality of Witt's writing is a clear demonstration of how effective the process of publishing your writing is for one's own development. I think he really cemented the idea of the clear benefits of continuing what I'm doing on Substack and growing as an investor. His analysis of where he fits in the investment universe and where he brings value was also a key insight. Recently, as I studied businesses, I became increasingly aware of the need of an edge over the other funds where I can bring value. I think that by studying Witt, I'm realizing, just as Monish and Buffett and others suggested, that I should focus on smaller companies. In smaller companies, the market is really more inefficient, especially in the more international you go, away from the United States. Though the rules of law and institutions here make investing safer. It's fun to mention that when Monish Pabrai, notable investor in the same school of thought, says that many investors start working in smaller companies and then graduate to bigger companies thereafter, as they continue to grow the fund size, becomes an issue. An issue for us at the moment, but food for thought. From Witt's letters, I also have many takeaways. I think that just in my takeaways of Francois Rochon's letters, the mistakes section is quite a useful tool. As promised, it will be making its appearance in the 2025 annual letter. The other is that an investor should really know their company inside and out. And although I haven't made my mind yet, I may add a more detailed write-up on the holding in the annual report to better track publicly my thoughts on our businesses. I have kept these private within the company. I'll add the discussion on focusing on management spurred quite a form of internal analysis. In the investing field, there has been a lot of debate whether you should talk to management. Guy Spier famously flipped from not talking to management to talking to them. Phil Fisher, as I mentioned, famously emphasized speaking to management. Many others have contradicting ideas, advocating for avoiding the sales pitches made by management. I think reading about Witt's progress, he clearly demonstrated the value of talking to management. Of course, trading carefully to keep yourself grounded is still a big must. Thanks to his work, it's very apparent that the smaller the company, the more you must communicate with management, as your investment fate is very closely tied to their efforts. Even a wonderful business is not strong enough to run itself. I think Wit Hugly is a very interesting character. It's admirable the way he set up his fund. I think his foundation is well positioned to help him succeed. Of course, I don't cover everything about him, and I recommend you check him out. I think many investors can learn from his letters, and it's worth keeping an eye on him. Although he's focusing on a smaller segment of the market, I think he is in no way at a disadvantage. So we wish Wit luck, although we don't think he needs it, and we will keep an eye on his work. Hopefully you enjoyed this piece, and I hope you all have a great day. This has been Daniel.